3 cheap stocks for March 2025. Number 1, Crocs. Footwear business Crocs has had a difficult start to the year, with shares down 9% year to date and 18% over the past 12 months. And there are some obvious reasons why Crocs has underperformed. Revenue growth has slowed to just 3.5% on a trailing 12-month basis, and the company faces tariffs on its imports from China and Mexico. Meanwhile, Crocs' acquisition of shoe business Hey Dude looks like a huge mistake. Sales have continued to decline, and management said that they expect revenues to drop another 7 to 9% this year. Despite that, Crocs' valuation is getting to a point where it makes sense to take the other side. The company has generated $923 million of free cash flow over the last 12 months, against a current market valuation of only $5.6 billion, which means the company is trading at a dirt cheap valuation of just 6 times free cash flow. The disconnect is clearly shown on this chart, which plots free cash flow and net income at a 15 times multiple versus market capitalization. For the chart to converge, either Crocs' earnings need to fall dramatically or Crocs' market value needs to move sharply higher. Number 2, Indra Sistemas, ticker symbol IDR.MC. Indra Sistemas is a Spanish multinational that operates in defense, air traffic, space and digital services, and the company is 28% owned by the Spanish government. Indra shares are up as the company embarks on a significant transformation. Under its Leading the Future plan, Indra is moving away from IT services to focus on defense and aerospace, a move that should pay dividends in the current geopolitical climate. Indra is targeting €6 billion of revenue by 2026 and $10 billion by 2030, representing over 12% annualized growth. Recent strategic moves include acquiring space business Hispasat and plans to sell its payments offering Minsait. Ultimately, Indra generates reliable cash flows, and the stock should benefit from increased military spending in Europe. Despite that obvious tailwind, the stock is still cheap at under 1 times revenue, 13 times earnings and 11 times free cash flow. Number 3, SimilarWeb, ticker symbol SMWB. Data as a service business, SimilarWeb provides tools that help companies measure web traffic and online trends. However, the stock has fallen 42% over the past month. SimilarWeb relies on web scraping and network relationships to gather its data, and the company's insights are frequently quoted on social media. The data is highly valuable for online companies looking to get an edge, and is even used by hedge funds and investment professionals. Meanwhile, SimilarWeb is increasing its investment into AI and starting to monetize its data for large language models. The training of large language models should